We'll go ahead and get started. Again, my name is Mike Camara. Thank you for joining today. I'm with Bogart Wealth. This is a webinar around what we call the after-tax rollover and mega backdoor Roth strategy. Before we get started today on the topic at hand, we'd like to just go a little bit into us as a firm. So Bogart Wealth is a registered investment advisory firm. We have about 2.9 billion of assets under advisement. We are, again, a registered investment advisory firm, completely independent. We work as true fiduciaries. We custody with Charles Schwab, so we don't hold any money here at Bogart. That's to safeguard our clients' investments. And with working with an IRA, we work with complex portfolios addressing unique needs that require a more high customization level and overall expertise. We're a fee-only wealth management firm, so we have no commission incentives. This is our team. There's James Bogart, the owner and president of the firm. There I am, Mike Camara. I am a certified financial planner. I've been doing this for about 19 years, and this is the rest of our advisory team. This is some of the rest of our team, including some of the leaders here. You can go to our website and look at the bios of each of our employees. Some further team members here. And then our investment management team. We have 3 office locations. I'm in the Woodlands, Texas. We have one in downtown Houston. And then McLean, Virginia is where most of our operations, investing, and planning team is located. So we focus a lot on comprehensive financial planning, which basically targets doing a holistic approach. So we look at basically doing a retirement analysis, determining cash flow withdrawal strategies, tax planning, tax optimization, investment management, estate planning, and then we monitor and review. You'll notice this is a continuous circle. We don't treat retirement planning as anything that's ever done. So we're going to continue to run through this process, primarily to look for any changes that we need to get in front of, whether it be something planned or unplanned. And so by doing this, we can continue to look at the longevity of any retirement plan. So this webinar today is part of our retirement readiness series. We have a number of others that we have done in the past. The recordings for those webinars are on our website. And we'll continue to do these in the future, as well as add additional topics here. Again, today we're going to be focusing on the mega backdoor Roth strategy. So the agenda for today is to number 1, go through an overview of retirement plan account types. Number 2, Roth conversion basics and reasons to convert. Number 3 will be how the mega backdoor Roth strategy actually works. And then also want to talk about something that's similar, but not really the same in the sense of tax liability, but that'll be number 4, the in-plan Roth conversions and after-tax withdrawals. And then the last, number 5, we'll give an example. So to start off, let's talk about the different types of qualified accounts. Qualified is another way to think of retirement accounts. So a qualified account is a traditional 401k, IRA, 403b, or 457b. The good part about these types of plans is that your salary is contributed on a pre-tax basis. You saved taxes every year while also saving for retirement. So basically, that is going to be a tax deduction for you putting money into one of these plans. You pay no taxes on gains until it's withdrawn, no taxes on any dividends or interest earned, and a lot of times you'll receive company match by putting money into a 401k plan. Then there's the other part. There's a tax penalty of 10% if money is taken out early. For example, if you take funds out prior to the age of 59 and a half. There are some exceptions to this, but for the sake of this webinar, we'll set that aside for now. Every dollar, both the original cost and the appreciation, will be taxed as ordinary income when you take money out. And you have to take out every dollar during retirement. That is alluding to what's called RMDs. I just got a question. Will this presentation be shared? Yes, if you'd like a copy of this deck, please reach out to us and we can send it to you. Yes, there's a Q&A here. Sorry, I forgot to mention that. Any questions, feel free to put them in the Q&A. I'll address them during the webinar, and any I don't get to during, I'll make sure I answer at the end. So the government enforces this promise of taking the money out with what are called required minimum distributions. We call those RMDs for short, or for short. And then that starts in the early to mid 70s, and that's dependent on how old you are. There is a substantial tax penalty for failure to withdraw on what the government basically forces you to do. So employer-sponsored plans have limits as to how much you can put into a 401k or 403b. The limit on a pre-tax or a Roth basis is $23,000. If you're over the age of 50, you can do what's called a catch-up contribution for an additional $7,500 on top of that. Across all sources, and this is going to be employer match, and then after you've hit the limit, you can contribute on what's called an after-tax basis. The total amount that can go into a 401k plan is, if you're under the age of 50, $69,000. If you're over to the age of 50 with this catch-up contribution, you can do $76,500 in total. So for traditional IRA accounts, IRAs are individual retirement accounts. Typically, they are not tied to any type of employer. You can set them up on your own with any financial institution. It's a lot less that you can contribute. You can contribute a total of $7,000. If you're over the age of 50, you can do another $1,000 on top of that. And there's no income limit if basically you're not looking for any type of deduction. So said another way, you can give up to $8,000 no matter what your income is, and you may or may not get a deduction. It will be deductible if you are covered by a plan, meaning that you are already in a 401k plan. It'll be fully deductible if you file jointly and make less than $123,000, or single and make less than $77,000. If you make between $123,000 and $143,000, if you're filing jointly, or $77,000 to $87,000 filing single, there will be a partial deduction with a contribution to an IRA. If you make above $87,000 being single, or $143,000 being or filing jointly, there will be no deduction, and that'll fall under this top category here. If one spouse is covered by a plan filing jointly, then that range jumps up. If it's not both people, that jumps up to between $230,000 to $240,000. That'll be partially deductible. Less than $230,000, fully deductible. Above $240,000, no deduction for the taxes. So taxes are progressive. What that means is when you're looking at income ranges, basically it's not all a fixed amount. Your first, call it about, if you're married filing jointly, $23,000 is taxed at a 10% rate. And then between $23,000 to $94,000, that goes up to 12%. Anything earned between $94,000 to $201,000 is 22%, and on through the brackets. The average tax rate, depending on where you fall, you can see here on the far right column. If you're in the 22% top marginal bracket, your average tax rate's around 17.1%. The reason we want to point this out is that progressive tax brackets favor a traditional or a pre-tax 401k contribution. Contributions are made at the marginal highest tax rate. Withdrawals are made at an average tax rate. Let me give an example of that to make that a little bit more clear. If you are making, let's say, around $200,000 a year, married filing jointly, your top marginal, top marginal tax bracket's going to be 22%. If you put $20,000 into your 401k plan, that $20,000 is avoiding taxation at 22%. Again, keeping in mind that your total income is around $200,000. Now, let's say you retire, you have no other income, and then you take that $20,000 out. Again, it has not been taxed. It has been contributed on a pre-tax basis. It avoided taxation at 22%. If you then take that $20,000 out and tax brackets are still the same, which they probably won't be by the time most of us retire, But if you take that $20,000 out with no other income, then it will, at that point, be taxed at the bottom tax rate, 10%. And so contributions go in from and avoid taxation at the top marginal bracket. When the money comes out, it starts at the bottom marginal tax bracket. So there's also Roth accounts. Roth accounts can typically be in a 401k plan. There are also Roth IRAs. And the benefit with a Roth account is that the salary is contributed on an after-tax basis. So you're not going to save on any taxes in the year that you're putting the money into the plan. And any company match at this point, this could change in the future, but any company match that goes into a 401k plan, even if you are saving in a Roth 401k, that will go into the traditional or pre-tax 401k bucket. So match will be taxable to you whenever you withdraw it. The benefit of the Roth is that it gives you tax-free growth. Again, you're not going to save on taxes now, but anything that it grows to over time, it will go tax-free. And the tax-freeness of it, or the tax-free withdrawals, are based on a couple rules. First of all, tax-free withdrawals of growth have to be done after the age of 59 and a half in most cases. Again, there's some exceptions, but we'll set that aside for now. And the first contribution to the Roth has to be done at least 5 years ago. So said another way, your first contribution has to be put in, or excuse me, from the point of the first contribution being put in, you have to have at least reached the age of 59 and a half, and 5 years must have passed. A tax penalty of 10% on any gains, if it's taken out early, could apply. But if you take out your principal, because you've already paid taxes on that, there's no penalties or additional taxes there. Roth IRAs are also not subject to those required minimum distributions because they've already been taxed and it's growing tax-free. The government does not have any incentive to force you to take that money out. The reason they have RMDs is so the government can start collecting taxes, basically. Beneficiaries also inherit that money tax-free. There could be estate taxes, but again, that's a separate topic. But with an inheritance of Roth monies, if a beneficiary were to cash all that money out, they would not pay any taxes on it. So the limit for Roth IRA accounts are the same as traditional IRA accounts. As far as if you're under the age of 50, you can give $7,000. If you're over the age of 50, you can tack on another $1,000 for a total of $8,000. But there are income limits as far as whether you can contribute to a Roth IRA at all. Now, this is just for Roth IRAs. There are no income limits for contributing to a Roth 401k. Keep that in mind, please. But the income limit is here. So if you make less than $138,000 being single or $218,000 married, you can do a full contribution, $7,000 or $8,000. If your income is between the 138 to 153 being single or 218 to 228 being married, then you can do a partial contribution, maybe $5,000, $3,000, whatever it is. And then if you're single and make over $153,000 or married and make over $228,000, you are unable to make a contribution to a Roth IRA. Conversions are different, but with the conversion, there's no income limit. So anybody, no matter how much they make, can do a Roth conversion at any point and for any amount. So the basics of Roth conversions are as follows. A conversion is a penalty-free taxable transfer of amounts from a traditional IRA to a Roth IRA. I'll send this deck out, but I'll make it very simple. So if you have money that has not been taxed yet in a 401k plan, let's say again, $20,000, you can convert that money into a Roth. And basically from there, once it's in the Roth, it'll grow tax-free. And again, as long as you wait at least 5 years, if that's your first dollar going into a Roth and you've reached the age of 59 and a half, any growth, if that 20,000 turns into $1 billion, and I'm just giving a very extreme example, but to hammer home the point, all that growth will be tax-free. You won't owe any taxes on that. Now, when you do the conversion, so if you do a $20,000 conversion, you will pay or owe taxes on that. So if you make $200,000 and you do a $20,000 Roth conversion, your total income or ordinary income for the year will be $220,000, and you will owe taxes based on that. So there are reasons, the main reasons to convert are basically if you're looking to diversify your tax exposure. I've done this for about 19 years. Most people that work for corporations have most of their monies in pre-tax dollars. Pre-tax 401ks, pre-tax pensions, those are where the lion's share of most clients' assets are in. And so this is a way to diversify tax exposure. Sometimes it's better to have Roth monies in a situation. Sometimes it's better to have pre-tax monies. It all varies. If your income is too high to give to a Roth IRA directly to do those contributions like I showed before, and you just want to get some money into a Roth, you can do some conversions. And if you think taxes will rise in the future, pay taxes now to save taxes in the future would be the idea. And then once again, like we illustrated, passing on Roth monies to beneficiaries is taking, if you pay taxes for them, they're not going to have to pay the taxes when they inherit the money and inevitably withdraw it. So again, this just reiterates that reasons to convert. If you think income tax rates will be higher in the future, if you expect your income and spending to go up significantly faster than inflation between now and the end of your plan, if income tax rates all go up in the future, if you will be in what's called RMD prison, that means that the government is forcing you to pull more money out than you actually need to spend. That happens quite a bit. Or if you, again, want to leave a better or larger legacy for families or individuals. So this is just talking about basically RMDs. If you live long enough, you will end up either depleting your IRA or your required minimum distributions, again, RMDs, will be greater than your living expenses. So that's, again, just kind of looking at when you're trying to get in front of some of the longer term planning, Roth conversions can help with this. So one thing we want to differentiate from the mega backdoor strategy is what's called in-plan Roth conversions. An in-plan Roth conversion can be done, but prior to doing any of this stuff, we recommend speaking with a financial advisor. And essentially, for anybody that has employer stock in their 401k plan, you want to consider the implications to any net unrealized appreciation strategies, NUA for short, before doing any of this stuff. And we can help with that. So we do offer complimentary consultations. So I'll mention that at the end again. If there is anybody that would like to have us look at their situation, we do that on a complimentary basis. So when it comes to a in-plan Roth conversion, let's say, for example, in here, I'm going to give an easier example than what's listed here. Let's say you have $100,000 of post-tax money. Your post-tax money, and this is an example of a Voya statement for Exxon. Your post-tax money is listed here in the blue circle. So you have $270,000 in post-tax contributions. That money's already been taxed. That's what's considered after-tax money. This after-tax account of $562,000 is what the post-tax dollar amounts have grown to. So basically, that $270,000 has had about $300,000 worth of growth. That $300,000 worth of growth is pre-tax, meaning that anything it grows to while in the 401k plan will be taxable upon the point of withdrawal. So you can do in Voya a in-plan conversion, but there's a ratio as to how much will be converted from the after-tax amount versus the earnings. And so a better example, just to illustrate this, is let's say this after-tax dollar amount is $100,000, and then the after-tax amount is $200,000. So you doubled your money, basically. If you did a $100,000 conversion, they would actually make you convert some of the earnings, and it would be about half of the earnings. So you would do a $100,000 conversion. $50,000 would be converted from the after-tax amount that's already had taxes, so no tax implications there. $50,000 would come from the $100,000 of earnings, and you would owe taxes on $50,000 from that conversion. So you can do that, but not really the best way we think to approach this. Instead of doing that, consider withdrawing the tax paid balance, which is this amount here, from the savings plan and rolling it over into a Roth IRA outside of the savings plan. If you do that, and I'm going to give some examples here, you still have to take those earnings. In my same example, you want to take out $100,000 and try and get into a Roth, but you don't want to pay any taxes. Well, you can't get the full $100,000 out, unfortunately, but you can get $50,000 out, and that $50,000 can roll into a Roth. The earnings of $50,000 can be deferred and not taxed, and that can go into what's called a traditional IRA. You're still getting $50,000 into a Roth, but you're not paying any taxes. That $50,000 of earnings has to come out, but it will be rolled into a traditional IRA, so you will not pay any taxes on that. And that's what it says here. In order to do so, the attributable gain must also be withdrawn and rolled over into a traditional IRA outside of the savings plan. So this is an example. If you have the pre-87, post-86 tax paid balance of $274,049.15, you are able to take out that full dollar amount. But if your after-tax balance is $562,756, they're going to take a proration of that amount. Basically, you take 274,000 divided by 562. So that is, 274 divided by 562. That's about 48%. You multiply that by $274,049, and that'll give you about $133,000 that can roll directly into the Roth. So out of this after-tax dollar amount, $133,000 can come from that balance and go into a Roth. The remainder of this 274, remember, this is the total amount you can take out, will come from the gains, and that will go into a traditional IRA. Now, let me again compare this to doing an in-plan conversion. If you did this exact same in-plan conversion and converted $274,049, it would work the exact same as far as the ratios, except with the in-plan conversion, you would now have $140,000 of taxable income. Probably not the best idea, but again, everyone's situation is different. Better to defer that, roll the $140,000 into the traditional IRA, and consider converting that when you retire and maybe your income drops, basically. So this is what the whole idea is behind the mega backdoor Roth strategy. There's a lot of money you can get into a Roth IRA compared to just doing regular contributions or even savings on a Roth basis in a 401k plan. So this goes a little bit more into the in-plan Roth conversions. Prior to doing this, consider the implications again to any net unrealized appreciation strategy that's dealing with employer stock in the 401k plan. And the mega backdoor Roth strategy is a rollover. That's very different. It's technically a withdrawal rollover, but that's very different than a conversion with the savings plan. And again, that can have unexpected tax implications, as I pointed out in the previous example. So a few other points around that. Employees younger than 59 and a half can convert a portion or all the balance of the after-tax amount and the general, and general accounts or the Roth conversion accounts. However, the funds in the before tax account cannot be converted. Employees 59 and a half or older can convert a portion of all the balances into their Roth accounts. The basis of your stock does not matter for these conversions. When people select higher cost basis shares, the IRS doesn't really care about any of that. Stocks will be liquidated in order to complete the conversion, and it's unable to be reinvested for a period of 5 to 7 days. And this gives the example that I mentioned before on the ratio. If you convert 100% of your after-tax accounts, then basically 40% of it will be taxable. Let's say in the example, 60% is after-tax contributions, 40% untaxed appreciation. then basically, again, if you convert 100% of the after-tax account, 40% will be taxable income. If you convert 50% or half of the after-tax account, 40% of the 50% will be taxable income. And if you convert 10%, 40% of the 10% will be taxable income. Bottom line is, you do an in-plan Roth conversion, you're very likely to owe some taxes unless that after-tax money that you've put in there has had no growth, which is its own problem. So the mega backdoor Roth example for a full year is listed out here. So in this example, we have a base salary of $225,000. We're looking at a marginal tax bracket of 24%. We're giving 10% on a pre-tax basis, 5% on an after-tax basis. Again, that's different than a Roth basis. This is after-tax. So if you put the money Roth, the earnings grow tax-free. If you put the money after tax, the earnings grow pre-tax. The earnings will be taxable when you draw it out. Why would I give money on an after-tax basis instead of a Roth basis? Because the after-tax savings are in addition to how much you can put in on a pre-tax or Roth basis. So I would not personally put any pre-tax or Roth monies in, or excuse me, any after-tax money until I've maxed out my pre-tax or Roth, but different conversation perhaps. Catch-up is $625 per month, and then the company is matching 7%. This assumes the employee is already over the age of 50. So basically then the totals that we're looking at, $22,500 on a pre-tax basis, $11,250 on an after-tax basis from the salary. The catch-up will be another $7,500, and then the company match will be $15,750. The total that has gone into the 401k plan is $57,000. And this is compared to a $7,000 direct Roth IRA limit, dependent on, again, what your income is or not being able to do anything if this income were higher. You could also make a special contribution, meaning that you can add even more money into the plan, even more after-tax money to get this to the maximum of $76,500. And basically that would be eligible to add into what you can roll over eventually to a Roth. So the way it works is that you put in your after-tax contributions. It has a pit stop into the 401k plan. And then as soon as you can, you roll that money over into a Roth IRA. As soon as it hits the Roth IRA, any growth from there is going to be tax-free. So this gives an example basically of doing full year contributions with an income of $225,000, 7% company match, and kind of what that turns into every year. Basically, in this year, we're doing $11,250. This year, $22,000, and then we're doing that pretty much every year. So a total over 10 years, we're contributing $112,500 to after-tax savings that we're rolling out into the Roth. And then the year-end value is going to be about at a 6% growth rate over 10 years, $148,284. And so that growth could be all tax-free. Here's another example just using a higher income. The base salary is at $400,000. We're now looking at a 32% marginal tax bracket, saving 5% on a pre-tax basis, 5% after tax. Catch-up is $625. Company match is 7%. We put in $20,000 on a pre-tax basis, $20,000 after tax, $7,500 catch-up, and company match in this case is $24,150. Not eligible to make any or put any money towards a Roth IRA directly because this income is too high. Company match is also limited based on income at $345,000, so they can't match above that. And then in this case, they could still squeeze in a little bit more money. They could still put in another $4,850 after tax to get to the full maximum that can go into a 401k. So once again, we've got an after-tax contribution of $20,000. It has a pit stop in the 401k plan. Get it out of there, get it into the Roth, and have it growing tax-free. So if you're giving $20,000 every single year, over 10 years, if your growth rate's at 6%, we're looking at that getting up to about $263,000. So basically, when you're looking at this, it's not a strategy that is very well known. It's got a lot of nuances to it. It's a little bit more on the complex side, but the benefits of it can be quite good. So you want to speak with an advisor. We would recommend, whether it's us or another, before trying to do this yourself, because I have actually seen people do in-plan conversions when they thought they were doing make a backdoor rollovers, and then they get stuck with a tax bill, not really expecting that. So have someone that's a certified financial planner that knows your retirement plan. Every retirement plan is different. The example I was giving there was with Voya. Certain 401k plans do not even allow you to take after-tax money out. They're all a little bit different. So have an advisor that knows your retirement plan, or at least knows where to get the information needed to make a determination around your retirement plan. An advisor that knows the IRS retirement rules, has navigated multiple business cycles, and we also recommend advisors that manage portfolios. And then basically, you want an advisor that discusses various strategies. I made the example that typically an in-plan conversion is not the right way to go. There are some times where an in-plan conversion is the right way to go. Like I said, a in-plan conversion of after-tax money that has no growth does not have any taxes involved. And so you can do an in-plan conversion, keep it in your 401k plan, and not have another account, make life a little bit simpler. You want someone that provides financial planning based on your needs and risk tolerance. A lot of times we lead with financial planning before anything else. And also an advisor that does portfolio performance reporting. We find that to be important. Also understandable, speaks in a way you can understand. And so once again, we would like to offer a one-on-one financial strategy session. If that's something you'd like, please go to our website and you can submit a request to have someone contact you. We'll set you up with one of our advisors here as a complimentary session with no commitment, nothing like that. Just an opportunity to get to know your situation, see if you'd be a good fit for us. We'd be a good fit for you as clients and advisors. So here's our contact information. I'll leave this up here for a moment. And basically, feel free to call us. Like I said, you can go to our website and feel free even to stop by one of our offices here. But I'll pause here for a second. Is there any questions that I can address that anybody wants to put into the chat? What is the considerations you should take into account related to NUA? Yes, so basically, this is going to get a little complex. NUA cost basis, basically, whenever you declare NUA, your cost basis is taxable to you. If you have after-tax money in your 401k plan, when you declare NUA, you can apply the after-tax money to your cost basis. And when you declare NUA, you won't have the cost basis if the after-tax dollar amount's enough. You won't have the cost basis for your NUA shares taxable to you. So if you take out all your after-tax money, then whenever you declare NUA, that cost basis, again, will be taxable to you. If you keep the after-tax money in there, you can apply it to the cost basis and avoid taxes on that piece when you declare NUA. Good question. On the next one, on the IRA contribution outside of 401k, would the 7,000 plus 1,000 with the catch-up apply to one person or each for the married couple, two persons? So it's each. So each couple can contribute 8,000. So basically, if you have a joint couple, husband and wife, and they're over the age of 50, the total for the household they can contribute is $16,000, 8,000 for each of them. Good question. Right, I'm gonna type in my email address here. Bill, I'm gonna do that under your question. And the reason I'm going to do that is if there's anyone that would like a copy of these slides, and we'll also have a recording of this webinar posted on our website here shortly. It's just real eager to see this webinar again. We've done this earlier in the year. There is a recording of this webinar on there, but I'm going to put my email in here. Oops, I didn't show up. Okay, so never mind. Let me actually get the chat going. Hopefully everyone can see this. All right, that is my email address. If everyone can see this, feel free to email me directly if you would like a copy of this deck. or if there's a question you want to ask me that you weren't comfortable asking live. My post 1986 contributions is 24,000, but my contribution summary for after-tax account is only 3,000. Guess I could only convert my 3,000. I don't think so. The contribution summary is probably what you have put in this year. So there's different, I could confirm if I could see the statement, but basically, there's the contribution amount you've done for the year, and then there's the total you've done over your entire time in the 401k plan. So basically, that 3,000 bill is probably the savings you've done just for this year would be my guess, but I'd have to look at a statement to be sure. And again, if you'd like us to do that for you, feel free to reach out and we'll get you with someone to take a look at that for you. Okay. Yeah. Like to look at that. Have to look at that more closely. Any other questions? All right, well, I'll go ahead and I'll wrap up then. Thank you, everybody, once again for your time. If you have any questions that come to you or again that you weren't comfortable asking live, feel free to email me directly for any questions on this webinar. Again, email me directly if you'd like a copy of the deck. And if you'd like to sit down with an advisor, please contact our office either by calling us or on the by submitting a request on our website. And I got it now. I think click on our disclosures. So here's all of our disclaimers. Let me just click through that. And then we've got now content that we put on Facebook, LinkedIn, Instagram, and YouTube. Follow us for these webinars and a lot of other topics that we like to cover in the financial world. And once again, I want to thank everybody for their time. Have a great week.